Alrighty guys, welcome back to another episode. In today's video, we're going to be talking about how to correctly buy dividend paying stocks. We're going to be doing it step by step. So I hope you guys enjoy this video, and if you guys do, make sure you guys smash the like button and subscribe to the channel if you guys aren't already. Also guys, I want you guys to do me a favor. Now, I just started my podcast back up. I'll put a link down below, so make sure you guys subscribe to the YouTube channel, The Carter Farr Show. That will be the first link down below. We will talk about investing, money management, trading, and you guys can listen to it pretty much anywhere where you guys listen to podcasts, so make sure you guys go ahead and check that out. So now let's jump into it, roll the intro, let's go. Bam. So step number one with buying dividend paying stocks, you guys need a stockbroker. Now, my personal recommendations are a company that is online and has a commission-free buying and selling. The reason why commission-free is by far the best, so you don't get hit with nasty fees that a lot of brokers charge. So my top three brokers that I would highly recommend, the very first one is TD Ameritrade. The reason why I love this one so much is because they do have a lot of features that income or dividend investors need, like DRIP, which is the dividend reinvestment, and they do have a ton of apps and stuff that you guys can use for dividends and trading, and their charts are just a little better, and they have a scanning feature on the website, so that's great. The second broker that I would recommend is Robinhood. This is a beginner-friendly broker that really allows you guys to open up a broker's account within like 5 minutes. I highly recommend it. Commission-free trading, they have DRIP, and they now have fraction shares. So if you guys can't invest in a full share, you guys can just buy or pick up a little piece of it. The third one is Fidelity. Fidelity has a long, reliable history of being a stockbroker and, you know, being in the field. So that is a good one as well. All of those are commission-free and pretty great. So choosing your account type, really there's two different accounts that you guys can sign up. The very first one is an IRA or a Roth IRA, and then the second one is just a standard broker's account. Now the standard broker's account is going to really allow you guys to invest and put in more money starting off. But your IRA account, you guys have a lot more tax benefits when you guys want to retire. So it's literally up to you guys. Both of them are great for the long term. So after you guys go ahead and get a broker and your account type, the next step is research and creating a set of rules that you guys have to follow. Now there's a ton of websites out there that really have dividend screeners and stuff like that, but really my go-to is pretty simple. I like to have a lot of blue chip stocks. So these are companies that are worth hundreds or billions or even trillions of dollars. These companies have a long, reliable history, they have consistent dividend growth, and they're just a perfect go-to stock. But you guys should still have a set of rules that you guys have to follow. Some of mine are not chasing dividend yields. Why this is so important is because you guys should have a high quality stock that pays a 3% dividend rather than a riskier stock that pays a 6 or 7 or even 8% dividend. The reason why that's so important is because growth. Now, a stock with an 8% dividend is more likely to go ahead and cut their dividend because they're going ahead and they're giving out so much money to their investors, rather than a stock with a 3% dividend isn't giving out as much and they're reinvesting that money back into the business, which is overall going to grow it. Also guys, don't be afraid to throw in some ETFs into that account because that's just a perfect balance, but we'll get into that. Some of the top screeners and scanners that I would highly recommend, you guys can find Dividend.com that has a ton of cool dividend screeners, so you guys can check them out, and you guys can check out Finvest. Both of those links will be down below, so make sure you guys check them out for dividend investing. Now, step number 3 is building a base. Now, the reason why building a base is so important, especially with dividend or even building up any investment portfolio, is because you want to minimize risk and maximize reward. So this is why I would highly recommend having a nice solid base of ETFs, bonds, and cash. Now, would I go crazy leaving 100% of your money in cash? Absolutely not. You guys want to put about 40 to about 50% of your money into ETFs that just track the S&P 500. This is so important because you guys are going to get around a 3 to 4% dividend depending on which ETF that you guys invest in, and you're just going to compound that over the long term, and those get around 10 to 12% of total gains each year. Now you guys are going to go ahead and put around 10 to about 15% of your money in bonds. Now depending on your age, you guys should slowly increase it as you guys get older. Why this is so important is because bonds have a tendency to not move as much, but you get paid a 3.5% dividend to hold them, and they do and perform better in a falling market. So when the market is falling, go ahead and turn towards bonds, and they're going to act as your defense. And then when a lot of stocks become on discount, go ahead and transfer some of your bonds into stocks, sell the bonds and just buy stock, and then build it back up when the whole economy and the market starts going up. And then I would always recommend leaving, maybe 1 to about 5% of your money in cash. Why that's so important is because waiting is going to be your key feature when investing. So you guys want to be able to have cash on hand to go ahead and invest in companies that are undervalued or just have growth. Now, step number 4 is very important. This is called DRIP, also known as dividend reinvestment. The reason why this is so important is because you're going to get around 3 to about 5% more per year doing this in total growth. Really what this does is it compounds your money faster. So with each dividend you get, you're going to reinvest it right back into that same company, and then that dividend is going to give you dividends, and then you're going to have this compound effect, which is overall going to make you a J curve on your portfolio, and it's going to make you a ton of money in the long term. Step number 5 is repeat, also known as consistency. With any investment, being consistent is one of the most important things that you guys need. I don't care if you guys are working out. If you guys go to the gym one time, you're not consistent and you're not going to get healthy. I don't care if you guys eat one meal, you're not healthy. You guys got to build consistency with investing. It's the exact same thing. So you guys go ahead and set a certain amount that you guys are going to go ahead and invest each month. I would recommend $200 to $300 per month. Take it and invest it into dividend paying stocks, ETFs that track the market, bonds, and save some for cash to find undervalued stock. Once you guys do that, you guys are going to be killing it, I can almost guarantee. Let me know what your top 3 dividend paying stocks are down below. I would really love to check them out. So really, that is how I buy my dividend paying stocks. I hope you guys enjoy it, and if you guys do, make sure you guys smash the like button. If you guys got anything in value out of this video, go ahead and check out my blog, moneywithcarter.com. You guys can find everything right there. So we'll see you guys tomorrow in another episode. Remember to stay happy, stay positive, and overall stay safe out there. We'll see you guys tomorrow. Take care. Bam.